This is the second video in our Smart Money Concept series. In today's session, we'll be exploring how to accurately identify valid order blocks using the Smart Money concept. Here we have the 5-minute chart of Nifty, where the market opens, finds a base below, rebounds upwards, and surpasses its previous high. But soon after, it drops sharply with large bearish red candles. However, instead of breaching the last low, it pivots again, breaking through the prior swing high and climbing further. Now in this movement, based on price action, we had mapped out a support level just below this bearish candle or near its wick region. But the market reverses even before touching that support zone, leading many retail traders to anticipate a long entry once the price nears that area. They wait, but the market reverses without ever reaching their entry, leaving them sidelined. Chances are, you've experienced this frustration too while trading. But if you combined that support zone insight with the Smart Money concept and knew how to mark a valid order block, then you would have highlighted an order block area like this. The moment price dipped into that block, you'd have had a clear opportunity for a long entry. That's exactly why understanding order blocks is essential. If that's something you're interested in, as always, make sure to hit the like button to show your support and subscribe to our channel if you're new. See you after the intro and disclaimer. So, what exactly is an order block? Let's break it down. Imagine the market is in a bullish trend, forming higher highs and breaking structures consistently. Now, when a large institutional buyer, smart money, wants to enter a long position, they can't just jump in and place a full market order at one price level like we retail traders do. Why? Because their order size is massive. Unlike us, who might be trading with a few thousand rupees or dollars, institutions are dealing with lakhs or even millions in volume. If they were to place a full market order at a single price point, their sheer buying pressure would push the price up rapidly, causing them to get filled at increasingly higher prices, also known as slippage. This results in buying at a premium, reducing their overall profit potential. Let's understand with a simple example. Suppose an institution wants to buy 2,500,000 rupees worth of a stock. But at the current price level, sellers are only available for 200,000 rupees. So, when the institution places a buy order, only 200,000 rupees worth of their order gets executed immediately. The rest remains unfilled because buyers and sellers must be equal for a trade to execute. To avoid this inefficiency, institutions break their large orders into smaller chunks and place them across a zone, not a single price point. This zone becomes known as an order block. Now, if some of their orders remain pending, smart money will often manipulate the price to revisit that same zone, allowing those pending orders to be filled. That's why we often see price pulling back into the zone before continuing its trend. This re-entry is where the remaining institutional orders are executed, leading to a strong price move in the expected direction. Right finger in simple terms, an order block is a key demand or supply zone where institutions execute large buy or sell positions. Recognizing these zones gives smart traders a significant edge because you're essentially aligning your entries with the footsteps of big money. Most retail traders have a basic idea of what an order block is and how to spot it on a chart. Typically, during a strong uptrend, when the market makes a sharp bullish move starting from a green candle, many traders consider the last bearish red candle before that move as the order block candle. Similarly, in a strong downtrend, the first green candle before the price drops sharply is often labeled as a bearish order block candle. However, identifying order blocks using just this visual pattern is a common mistake. Why? Because this method relies purely on appearance without understanding the rules or techniques that define a valid versus invalid order block. Simply marking candles in this way can often lead to false signals, increasing the chances of placing losing trades. That's why it's essential to learn and apply specific rules to accurately identify valid order blocks. Let's break down these rules step by step so you can apply them confidently in your trading strategy. Checkmark rule number 1. Last candle must sweep liquidity. To identify a valid order block, the first and most important rule is liquidity sweep by the last candle in the move. Let's break it down. In a bearish price action, if the market makes a strong bullish reversal right after the last bearish, red, candle, then we check whether that last red candle broke the low of its previous candle. If it did, it means the market swept the liquidity below that low before moving up. Checkmark result. This is a valid bullish order block. But on the right side example, the last bearish candle did not break below the low of the previous candle, meaning no liquidity was swept. Cross mark result. This is an invalid order block. Now let's consider a bullish market structure. If the price makes a sharp move down right after the last bullish, green, candle, and this green candle broke above the high of the previous candle, it indicates a liquidity sweep to the upside before the reversal. Check mark result. This is a valid bearish order block. But in the right side example, the last bullish candle fails to break above the high of the candle before it. Cross mark result. This is not a valid order block. Check mark rule number 2. Inefficiency, imbalance, fair value gap. After identifying the last bearish candle that breaks the low of its previous candle, the next thing to observe is the sharp bullish move that follows. In this move, you'll often notice a distinct price imbalance or inefficiency, which is key to validating an order block. Here's how to identify it. Take a close look at the 3 consecutive bullish candles that form after the last bearish candle. If you compare the wick high of the last bearish candle with the wick low of the third bullish candle, and there's a visible gap between them, that gap is known as a fair value gap, FVG, or price imbalance. To mark this imbalance, simply draw a box between the high of the bearish candle's wick and the low of the third bullish candle's wick. Check mark if this imbalance exists. The order block is considered valid because smart money likely didn't get all its orders filled in the initial move, increasing the probability of price returning to that zone. However, in some cases, the lower wick of the third bullish candle comes down and taps into the order block area, filling the remaining pending orders. Cross mark when this happens, the imbalance no longer exists on the chart, and the price has already reacted to that zone. Therefore, the order block becomes invalid, as there is little reason for the market to revisit that area. All institutional orders have likely been executed. Check mark rule number 3. Unmissed order block. A valid order block remains effective only until it is tapped, meaning, it should be used only once. Let's break it down. Suppose we have a red candle that sweeps the liquidity of its previous candle. If an imbalance, or fair value gap, also exists after this candle, it indicates that there's a strong chance the price might return to this zone in the future to fill pending institutional orders. Check mark as long as this zone remains untouched. The order block is valid and has the potential to trigger a reversal when the price revisits it. Cross mark, however, if the lower wick of the third bullish candle comes down and touches or taps into this order block zone, it means the pending orders have likely been filled. Once this happens, the zone is considered used, and the order block becomes invalid. The price is now less likely to reverse from that level again because the smart money has already completed its execution. Check mark rule number 4. Valid break of structure on the chart. In this example, the market is moving upward by forming higher highs and consistently breaking structure. Near the most recent swing low, the price aggressively pushes upward and breaks its previous swing high, signaling a valid break of structure, BOS, a key condition for a strong bullish trend. Now, let's analyze the order block criteria. Check mark liquidity sweep. The last bearish candle broke the low of its previous candle, sweeping liquidity, satisfying our first rule of a valid order block. Check mark imbalance, fair value gap. An imbalance is formed between the next 2 bullish candles, and the lower wick of the third candle hasn't tapped into the order block area yet, meaning the block remains unmitigated. Check mark unmissed zone. Since price hasn't touched this order block, it's still fresh and considered valid. At this stage, everything looks perfect, but one key element is missing: inducement. Magnifying glass. What is inducement? Before returning to an order block zone, smart money often traps retail traders by triggering a fake breakout. This is called inducement. Upward trend. The price pushes aggressively toward a previous high, creating breakout candles that trick retail traders into believing a breakout is happening. These traders jump in with buy orders, only to have their stop losses hunted when the price reverses. Downward trend. The market then dives back down to the original order block, fills institutional orders, and resumes the original trend, catching retail off guard. This liquidity trap is intentional. Smart money uses inducement to grab liquidity before returning to execute its remaining orders. Key summary: for an order block to be fully valid, it should satisfy the following conditions: checkmark liquidity sweep, checkmark price imbalance, inefficiency, checkmark unmitigated zone, checkmark valid break of structure, checkmark inducement, fake breakout. Order blocks work in both bullish and bearish markets, and can be used across all time frames, but the higher the time frame, the greater the accuracy. How to enter the trade by looking at the order block. This is the 5-minute time frame chart of Nifty. Here, after the market opened, the price moved downward and then broke its swing high, which created a valid break of structure on the chart. Now, as the price moves strongly upward from the bottom, this last bearish candle has swept the liquidity below it by breaking the low of its previous candle. After this red candle, two small candles are formed on the chart, whose opening and closing are almost inside or around this red candle, due to which we consider both of these candles as inside candles. Then, a strong bullish candle creates a big imbalance here, and since no candle has mitigated this order block yet, this order block remains unmissed. Along with this, a valid break of structure has also occurred here, so we can consider this order block as a valid order block. We have identified a valid order block here, but how to enter the trade in the order block area? Let us now understand the main ways of trade entry. There are 3 types of this. Number 1, entry at the top area. You can use this order at the starting point of the order block to make your entry. Place your limit orders around this area, keeping your stop loss below the low of the order block candle. This ensures that if the price comes down and forms a long lower wick candle and goes back up after tapping this area, your trade entry won't be missed since your limit order is already in place. Number 2, entry at the 50% area. In this type of trade entry, when the price comes around the 50% level of the order block area, you can plan your entry here. Keep your stop loss slightly below the order block area by allowing a buffer zone. This entry is usually considered when the size of the order block candle is large, helping to minimize the stop loss. Number 3, entry at the bottom area. In this type of trade entry, your position is taken at the lower levels of the order block. Your stop loss shifts further downward. However, many times the price may move up after tapping the top of the order block or the 50% area, causing you to miss the trade if you wait for the lower levels. Because of this risk, most traders avoid this type of entry. Now, we have placed our limit buy order at the top of this order block area. After some time, the price touches this area with a long lower wick and again moves up, following its previous trend. Since the market structure here was bullish, we made a trade entry on the bullish side. If the price action were bearish, we would plan the trade entry on the bearish side. Now, let's understand some important points about a valid order block. Point number 1. If a bullish trend is ongoing in the market and the price moves from bottom to top, then if a green bullish candle breaks the low of the last bearish candle, we will consider this green candle as an order block candle because its low has not been broken yet. While marking the order block, we do not consider the color of the candle. Similarly, in a downtrend, if a red bearish candle breaks the high of the last green candle, then we also consider it as an order block candle, as it has broken the high of the previous candle. Point number 2. The order block remains valid as long as it is untouched. If the price taps a valid order block once, the block is considered mitigated and will not be useful in the future, as an order block can be used only once. Point number 3. In a bullish market structure, we should always mark the bullish order block and plan a long trade accordingly. Similarly, in a bearish trend, we should mark the bearish order block and plan for a short trade. Point number 4. After marking a valid order block, there is no guarantee that the market will always move in the direction of your trade entry. Sometimes there will be small moves, sometimes large, or the market may break the order block entirely without respecting it. Therefore, always use a stop loss to protect your capital and manage your risk. In the next video, we will understand more topics based on the smart money concept. That's it, traders. Thanks for watching. I hope you found value in today's video. If you did, don't forget to hit that like button, it truly helps support the channel. And if you're new here, make sure to subscribe and turn on the notification bell so you never miss any future content. Thanks for watching, and I'll see you in the next episode.